and welcome to the Build and Exit podcast. I'm Julie Wilkerson and I'm the owner and founder of Wilkerson Accounting Solutions. I'm really excited to be here with Kush Birdi, who is the owner and founder of Birdi and Co Solicitors. And we're going to be talking all about M&A today. We're going to look at different parts of the process because we both specialise in mergers and acquisitions, and I have a lot of conversations with people, buyers and sellers, about how to prepare for exit, but also key things to think about when buying businesses. So Kush is a really experienced M&A advisor, working on sort of 1 to 10 million deals. His solicitor firm sort of does his sweet spots around 1 to 3 million, and probably worked on 50 to 100 deals over his time in M&A. So there's going to be lots of expertise in the room today. So Kush, first of all, I'd like to hand over to you.
Thanks very much.
Tell a little bit about yourself and why you chose to come on the podcast.
Mm-hmm. So thanks Julie for the introduction there. So I think that, so as Julie said, I'm the managing partner and co-founder of Birdi and Co. Our core area is M&A. And the reason why we wanted to do this podcast today is just to really give practical insights and share our experience in terms of what we see on M&A deals, whether it's on the sell side or the buy side, with the combined experience on the sort of the financial and accounting side and the legal side. We're both obviously collectively well placed to share the trials and tribulations and the successes, of course, of the M&A deals we work on. So it'd be really good to use our combined experiences in the way. So I hope that everybody can receive really valuable information and in order to help them maximize their strategy of whether it's acquiring or if you're looking to sell down the line, then hopefully this podcast will be really helpful for you today. Touching upon sort of like the due diligence process, I suppose. My understanding is you support acquirers in their due diligence process.
Yeah. So if we've worked with the seller to get ready to exit, we'd be on the sell side due diligence, having the pack, everything ready. Obviously, if the buyer approaches us, we act as the acquisition CFO for the buyer. So we'd help them on their due diligence. So we basically do financial, operational and tax.
Okay.
Are the areas of due diligence that we look at.
Yeah.
Now, that would be our full package. And the reason we suggest commercial and financials done together is because there are a lot of the commercial questions will eventually impact the cash flow. So when we go back to all this risk planning, scenario planning, and corporate governance, like safeguarding the business, that all does come around the commercials. But in the end, the commercials is what impacts the cash flow.
Yeah, I guess like things like debt recovery, recovering invoices, that kind of thing is, I guess, a big part of that. The procedures, I mean, for that, what the process is in place for that kind of stuff is relevant, I guess.
Yeah, and just things like, people that try and do their own, I'm not saying that business owners aren't commercially savvy. It's not about trying to say they can't understand it, because obviously they will have their own discussions and be doing it. But it's how will things impact that later forecast. So for instance, we do only do financial due diligence for people if that's what they choose, if they've got a commercial team. But it doesn't always sync as well as if you do the full due diligence, because for instance, if we do the financial only, we'll do a top level forecast. Mm-hmm. But if you want to get into the trends, which we know seasonalities, the accuracy of bookkeeping month on month, profit margins, those trends show a lot about a business, because if you see poor trends, they've got poor bookkeeping. So that means fundamentally there's a bit of then, can you actually trust the overall accounts? Because if they haven't got answers to things. Yeah. And for instance, they'll always say, sellers will often say, oh, my accountant just did it for tax purposes. That's fine. But why haven't you got an adjustment then show it without that for tax purposes?
Sure.
Those sorts of things they should have ready. This is what the seller should have ready.
Yeah, so useful.
Because it just means a little bit. And if your accountant's doing it, and the accountant knows you're selling, then this is when you might want to bring third parties in, because why wouldn't you already have the adjustments there ready? I don't think you should be going into due diligence about those types of reports. But things where it impacts will just be things like, okay, your top 5 biggest customers. Okay, so fair enough, you can look at the contracts, you can look at when does it own, but how quick do they pay? So we always see sellers go, oh, they pay within 30 days, but what do your debtors they show? How quick are you paying suppliers? What do your creditors they show? Things like, is the business trademarked? because we have partners where we help with trademarking in our full due diligence. We would help at least a basic trademark search. But if it's not trademark, what's the financial consequence of it? That's the question you're asking, isn't it? If in the commercial and due diligence process you find things, in the end, the biggest risk is a financial consequence. So that always it's always the accounts that end up with the impact. That's why finance become a key part in the whole overall end-to-end planning of a business. Absolutely. Because it's the budgets, the cash flow and the finance that are always impacted at the end if something goes wrong. Like I say, even if by employees leaving, fines, suing, customers not paying, things like that, that all impacts the cash flow. So when we do our commercial scenario plans, we would really be delving down into not only the baseline of the business, because obviously there is a historic trend, also what does the buyer want to add on to grow the business, because that's obviously a key part of why the buyer's buying it, but also looking at what are the potential risk and budgets they might need in the forecast, the upfront fees, do they need to replace a role? Have they got enough staff? Are they behind? Are they understaffed? And then just budgets in general, should they have a provision for recruitment fees if they might need to, what would happen if 3 employees left? Because it has happened. Because we always know engagement in employees is a risk post-acquisition because they might not like the new structure. Yeah. So there's a risk that it could happen, quite a high risk, I think. And what does that do? So then I always think you need what's the worst case scenario, what's the best case scenario, and then a bit of scenario planning so that you can play around with the models to see. And that's what we would call commercial. Yes, there's asking questions, things like costing, but in the end, what do they do to the cash flow and the finances? That's going to be the critical thing in the end, because it's going to be that sustains the business long term.
Yeah, really useful. I mean, with the staff as well, I mean, it's always a sensitive issue as to what stage are they or some of them informed about the sale or the acquisition. That's often a sensitive topic where, again, collaboration has to occur. And when that happens, because that can be, it then drives into that commercial risk of what the reaction is going to be or not going to be. So all really, really important. I mean, on the legal side, due diligence is just so important on a range of issues. I mean, I think there's certain areas that whenever we're doing an acquisition, we would look at certain things straight away. We'd just get straight on it because they're just so important. Things like intellectual property protection, property. So if there's a leasehold or freehold property, then that's going to be critical because it's going to be either directly or indirectly a sizable chunk of the value of the deal. So we'd want to look at that really, really closely, especially if the business relies on its property, on its premises, which can be the case. But then even just other things like, outstanding. So if there's secured loans in the company, then we want to make sure those are going to be discharged at completion. But not just that, we need to make sure we've got the right paperwork as well, the right releases from those lenders to make sure we've got written evidence that there's no outstanding amounts owed to those lenders post-acquisition, because that's really, really important as well. There could be some kind of historic loan that's covered by, that wasn't disclosed, that the seller thought was paid off or probably maybe like 99% paid off, but it wasn't. And then actually the lender's security isn't released after completion because, we've got this historic loan where there's, X amount of interest outstanding. We're not releasing our security. So that can happen if you haven't got the right checks in place and you're not making sure you've got the right confirmations throughout the due diligence process and paperwork ultimately. So again, even with the commercial stuff that you were talking about, the legal aspects overlaps with that as well. And again, financial, because as you say, it all feeds into financial impact on the business if those risks materialize. So things like change of control clauses in contracts, it could be that there's, key assets which are on, hire purchase agreements or high value hire purchase agreements or financial leases, that kind of thing. And usually you'd want to look for, if there's a change of control, whether those financial products can be called in. That is definitely a legal risk that we see a lot, because someone that's providing asset finance or any kind of lease arrangements, are providing it to the company, but with the trust of the current owners, right, and how they've operated the business. But if there's a change of control, then that would then need to be reviewed, and usually there'd be a clause in there to allow those products to be withdrawn, which you obviously wouldn't want if you're acquiring a business. So those checks are really, really important to make. And there's other things as well. You know, are you registered for data protection? Those kinds of things we see cropped up. Is it all renewed? And there can be financial risks associated with that, and reputational risks as well. So yeah.
Yeah, there's a big risk, and I think our experience of post acquisition is operations do usually drop because what typically happens is the buyer doesn't want to work in it, which is fine, and they might have all that sorted. You know, maybe the old owner's staying on, but then what's that relationship like now that owner's being managed? You know, a lot of buyers will come in and want to have KPIs and the forecast, and these employees just aren't used to doing it, and by sort of, obviously you've got to try and put that in place, but you've got to try and put that in place whilst managing the expectations of those employees to a point, because you can't just come in and start dictating things that they haven't done. You know, you might have employees that have worked there for, 10, 20 years and never been asked to do it. And it does cause, and that's where like our experience as CFOs and financial experts is where we help, because obviously we've got experience from that from corporate. We're now corporate world. We used to work with we would work with the whole supply chain, like all the directors in the supply chain, and help them with their budgets and help them manage it. And we've got that experience of, I suppose, business partnering with different areas, and maybe if you haven't got that experience, we have seen people do it in quite dictatorial ways, and it does cause operational problems. We have seen people leave and bad relationship with employees, and ultimately in the end, if the employees become disengaged and the operations drop, just that alone will cause a cash flow issue. It's getting them engaged and which is why meeting the employees as part of the due diligence process and having conversations, I think is quite important as well. And making sure you bring on a HR expert for your deal as well. Make sure there's no issues on the employee side. And, getting an org chart and find out who the people are. The amount of times we see, it's a finance director and it's actually the owner's wife or husband. They're not a qualified finance director. Yeah. They've just put them in that role because they've done the bookkeeping for all the years. And obviously, I think as a buyer, they want to start getting the right people in place. And often buyers do typically invest, I think, especially post-integration, on the right type of thing. The right roles. But the question is, do they know what the right role is, like who the right role? Because that's one thing we would look at in due diligence, is we'd look at the finance team and say, where do we think the risks are? Because ultimately, if that buyer wants cash flows and reporting relatively quickly after acquisition, if they can't even produce a monthly, if they don't have anybody to produce this monthly management accounts, it's not just going to happen after acquisition, because someone's going to have to make it happen. Yeah, absolutely. And that's why, and this is where additional budgets like this consultancy post acquisition, the sellers never invested fully in the finance team. We see businesses of 5-6 million without a CFO. And you'd be looking at parts, they're probably not spending 50 grand's worth on finance that they should be spending. Oh, wow. Just the same, they might not have a HR advisor, they might not use a proper IT firm and things like that, which might be, underestimating. And this is the type of thing we would look at as part of our sort of budgeting, forecasting, because I think that's the most important thing, is the buyer building their own taking the sellers if they've got it. Normally they haven't, so they have to do it from scratch. But then taking it and building their own as to what they think needs in. Now, they might choose to then, sometimes it might be immaterial, like the odd 100,000 pounds here isn't going to materially change the deal, but it is a cash impact. Yeah. And ultimately paying back loans isn't a profit impact, it's a cash impact. So it's all a cash impact of what the cash flow will do after acquisition. Yeah, well, cash is king, they say. So and particularly post-acquisition, that immediate period is obviously critical, right? And that's what buyers are looking at straight away, right? Yeah. So yeah, really important. So on the due diligence side, do you work closely with the lawyers as well in the due diligence process, or do you kind of just do it as a side? Because usually the seller's side will set up a data room, like a sort of an online sort of portal to host all the documentation, disclosure documentation, and would you usually have access to that and sort of be able to review everything there? Yeah, I mean, we do like to keep in contact with all the advisors on the deal, because ultimately in the end they might share information. I suppose where we have our biggest involvement would be warranties.
Yeah.
So what we typically, obviously I know there is normal standard clauses, and maybe it's something you could touch on, is what are the normal standard warranties. So for instance, tax is usually a warranty. If there's a tax audit for historic tax, the seller's usually liable. But sometimes we might find specific things where we might recommend additional warranties, more for disclosure. I don't know whether, and this is why we liaise with the solicitors, because we don't always know, is it a warranty or is it in the disclosure notes or things like that, where the best place to put it is. But like as an example, if they've got invoice factoring and we've done the reconciliation on the balance sheet integrity and they can't reconcile the number, there's a risk.
Yeah.
And the discrepancy will be a percentage risk. And if we see big risks, well, ultimately it's down to the buyer if they want to proceed, because this would be times when is there a time if the seller's books are so bad, would the buyer pull out? But ultimately that's then down to, we would never tell the buyer what to do. Ultimately they can choose their own risk profile. But we would just highlight, and if we did see if they did want to continue, we might recommend an additional clause. Obviously it's then down to them to work with so we would probably say it in communications. We would then expect the solicitors and them to pull up the right terminology, because we don't know the legal terminology to protect them.
Yeah, absolutely.
And we have done that and it has worked, because the reason we do it though is we would let the solicitors write the legal words. Obviously most parties don't understand the legal terminology. We would focus more on explaining to buyer and seller the reality behind what we found, so that both of them, so that seller understands the risk as well, because ultimately if it happens afterwards, if something does come through tuition, the seller might know, they did explain that. It might just make it easier to have those conversations about having to go down the legal route to enforce it afterwards.
Yeah.
And then obviously we would expect the solicitors more to write the legal to protect the buyer from that element of it.
Yeah, absolutely. And we frequently work with different types of accountants on that, where we've had feedback, you need to put this protection in there, go and put it in right way or whatever. We might draft it and say, do you think this wording is okay? Is this wide enough or whatever? And to an extent you'll know, to an extent you might not. But I think, working together is always good. And I think it's just about getting the right protection. Yeah. But even, talking, when you were talking about just explaining the implications to the buyer, even if there is legal protection, I suppose you've still got to deal with it. In the first instance, you might be able to enforce a contract, but you then got to go and enforce it. But in the meantime, you've then potentially got an issue to deal with. So I suppose those are the conversations you're having in terms of saying, well, how are you going to deal with this whilst then enforcing this contract? Obviously, we'll deal with the enforcement side of it. And then in terms of, I suppose, usually if the price is subject to an adjustment based on the financial position on the completion day, which we call completion accounts process, we would usually request input from people like yourselves on sort of what those, how quickly they can be produced, the completion accounts, and whether there's any specific policies that should apply to formulating those. Do you support with all that as well?
Yeah, well, it would depend what we do with the buyer when they've bought the business and who the accountants are and bookkeepers and things like that. I mean, ultimately, normally a bookkeeper would transact. So that can, and we have bookkeepers in ours. So if, if someone's just on deal 1 or deal 2, we do often become like an outsourced bookkeeper. I suppose if they've, but if the accountants and the bookkeepers have transacted quite well within the acquisition process, it might be we don't need to do that afterwards. Our ultimate isn't always to do everything.
Yeah.
Sometimes some are better than others. Sometimes it has been really poor. Sometimes it's been okay. And we often on the integration we do mentor, train and help on board junior staff as well. So if eventually people need it internally, then we can help them do that. Or we would help work with the staff that are already there. And maybe our role might be to help train and oversee them if maybe there are some risks in it. So I think it will just depend who the team are on top. It might be they do it and then we review it. It's a secondary check, or it might just be they didn't really have a team. It was an internal admin doing the bookkeeper, and they just need the support, and then we would come and do it. So it would just depend on who the team are. But I think one of the biggest problems we see in acquisition is people trying to promote people because it seems like the easiest thing to do. We've seen people promote finance staff to maybe finance managers, and they don't really have, it's unfair because they haven't got the skills and experience at that time to do it. It doesn't mean they can't study to become it, but it could be unfair on them. And we also see it, people being promoted to managing directors and CEOs and things like that, just because they've been in the business 20 years, but they might not have the skill set to do that job.
Yeah, that's so true.
And again, sometimes this comes down to money because people do it for admin reasons, like simplicity. It's just easier to promote someone.
Yeah.
But this is why they want to have good conversations in due diligence to get a gauge of who the employees are, to see, do they think there's anyone capable? If they don't think there's anyone, if their gut is telling them, the buyers, their gut's telling them they haven't really got that person, either the seller stays on for longer and trains someone up if there's someone close ready, and if there's just not that person, then they might just have to recruit. But it's not always, but time, in the end, once they become busy after the acquisition, that's why you need the support post acquisition as well. So I just want to say thanks, Kush, for coming on the podcast. It's been really great. But if anybody needs help with legals, where can they find you?
Well, you can find me in lots of places. Social media, so I'm quite active on LinkedIn, so don't hesitate to DM me on there, or even Instagram. We are on TikTok. We're trying to get a bit better at that. Otherwise, you can contact me by email on Kush, KUSH, @birdielaw.com. And always happy to sort of have a chat with no charges involved for an initial chat. So don't hesitate to reach out.
Thank you. And I just want to say thanks to all the listeners on the Build and Exit podcast. We're nearly at 3,000 downloads now. And we've just set up a new YouTube channel. So if you loved the episodes, hit the subscribe button so more viewers can find our channel. See you soon.